All right, folks, how are you? Thank you. It's a pleasure to join you for an FX Street webinar. This is my first event with FX Street, and it's a privilege, and I appreciate allowing me to be a guest to your members. Let's get started on this. What we'll do is I'm going to move pretty fast, so if we can kindly keep the questions until we get to the end. What I'm going to cover today is one specific concept about price action, and it is kind of one of the root concepts of price action in its relationship to institutional order flow. I've got a lot of experience in this area, so let's just first get started by understanding that trading foreign exchange is highly risky, and you should all understand the risks as it pertains to trading in FX. My name is Chris Laurie, 13 years in foreign exchange, 10 years in funds management, registered as a CTA member NFA. Previous to my FX career, I was an athlete and I competed in 4 Olympic Winter Games. We're overall World Cup champions in the sport of bobsledding, and we won a number of titles and whatnot. So let's move on to today's subject, impact of order flow on price and volatility. So what we're going to do is we're going to tie in the relationship between how the order flow moves through the banks and how we sort of see certain behaviors reflected in price. And so we should be able to, the audio is okay. Sorry, we're just getting some feedback here. The audio is okay for you guys. Okay. So when we refer to liquidity in the market, those of you who are trading retail foreign exchange, you access your liquidity through a retail brokerage firm, most of you. So I'm going to talk about it a little bit deeper level and sort of how your retail brokerage firm accesses liquidity and the institutional effect on the order flow and price volatility. So there's basically 2 essential ways that you can access liquidity. One is through your bank, or through a bank. Typically, it is a global private bank, typically catering to clients with large assets, and the clients can be private individuals to large corporations. And the corporations can set up what's called prime brokerage to the bank, which offers a feed via an aggregator or global prices or an integrated feed from a multitude of institutions dealing in foreign exchange. The other alternative is that the bank offsets trades against counterparties from inside the bank. And what we're going to do is we're going to look at these 2 scenarios and how it affects price volatility and the nature and the different entities and how they deal in foreign exchange. And then we're going to look very, very specific at some technical elements of price behavior that you can perhaps adapt to your current trading model. Or look to integrate it in some way. So if we look at interbank flows via an aggregator, effectively this is how it's basically structured. So you'll have a bank, and we call it a PB, a private bank, or a private bank may act as what's called a prime brokerage. So the private banks, there's clearly a very, very large number of private banks. And they are what we call on the sell side of the market. So they're offering up liquidity to clients. And the clients, which can be private clients of the bank, investment funds, corporations, central banks, or other liquidity providers. For example, the brokerage firm that you trade through accesses their liquidity through a private bank and typically through prime brokerage at a private bank. Now, if you're, for example, an investment fund, you'll have an account with the private bank, and they will give you your liquidity for whatever FX transactions you want to take on, or whatever risk you want to manage in FX through that private bank. So the private bank has different arrangements with what's called the buy side flows. And the arrangement might simply be that they're accessing the liquidity through prime brokerage at the bank, or they're simply just accessing prices that are offered up internally from other parties that deal within the same bank. Now, there is an enormous scale of objectives based on the buy side of the market. So, for example, if you're a corporation, you will use the bank to simply try to hedge or manage your foreign exchange risk exposure. So they're constantly buying and selling and using different strategies through structured options and outright forwards and other hedging alternatives through the bank to acquire and build FX positions to manage their overall risks so that there's not too much FX volatility affecting the bottom line of the corporation. So then you might have on the other end simply a private client who needs to make an overseas purchase of real estate or what have you, and they will access the liquidity or the FX transaction through their private bank. Now, keep in mind that the retail market has this sort of common thought in that the FX market is the majority of the FX market is comprised of speculators. Well, yes, indeed, there is a speculative element in every FX transaction, effectively. However, they're not out there looking to, they're not monkeys sitting in a basement looking to sweep the book on someone's speculative transaction. Each independent entity has their own objectives in the market and will use the banks to do so. So what happens is the bank, if you set up prime brokerage in the bank, if you're an investment fund, you've got prime brokerage in the bank, you're effectively accessing the aggregate price. Now, the aggregate price will be available to you. You'll have an agreement with the bank in terms of what commissions you pay and what spreads you pay, and it's pretty straightforward. So you have access to a broader liquidity pool if you have prime brokerage rather than just an independent agreement with the bank, and that is what your retail brokerage firm, the type of agreement that they have in order to offer you tighter liquidity. So, okay. So let's just move on. So this is sort of one way that liquidity moves into the market because we need to get down to the technicals. So if you have accessing an aggregate feed, this is like a Thomson Reuters snapshot. If you've got an aggregate feed, you can see there's a multitude of banks. If you just focus on this column right here, there are a multitude of banks that are bringing liquidity into the market, into the aggregate feed, which certainly tightens up the spreads. So if you are an entity where you have an arrangement just simply with one bank, then the way it will work is that you will contact the bank via electronically or by phone, and you will your transaction. I'm even getting a note here that there's no sound at all. So I apologize. I'm just going to go forward, and then if we need to redo the webinar at a later date, then we can do that as well. Okay. Okay. So if this is a private bank, the private bank offers prices internally based on liquidity that is coming from other parties that have accounts with the bank. So if you've got an arrangement with the bank, the spreads will be wider, and the entity who is looking to transact with the bank will offset the trade to another entity transacting through the bank. So these spreads will be wider. Liquidity will not be quite as ripe as liquidity through an aggregator. And the reason why I'm explaining these very basic points is that it's going to come into effect when we start to watch its connection with price volatility. So it all depends on the objective of your transactions and the goals of your entity and the goals of how you're trying to position yourself within the FX market. And so some entities only need FX liquidity from their own independent bank. So let's have a look at sort of some of the effects that we can see if we're looking at our charts. If you're trading euro dollar, for example, and you've got, if the bank over here is a bank where you have internal dealing, so you have parties that are simply, looking at making a transaction from within the bank offers up the liquidity and offers it to party B. then you're going to have a wider spread. Now, the client A, for example, may have an arrangement with the bank where they're paying a 0.25% or 25 pips or even 50 pips dealing spread, whereas client B may be dealing on a 5-pip dealing spread, all depending upon the amount of volume that they do with the bank. So the bank has a fixed agreement with the parties, and they can really widen the spread or tighten the spread according to the relationship with the individuals. Now, these visuals will range in size from maybe a few $100,000 to clearly tens of millions of dollars. And when price starts to move, if you've got on this side, if you've got a private bank that's aggregating a feed and has a very, very tight spread, then those who are watching this feed, similar to one that you would see on your retail account, we were watching this feed, and that is basically the interbank feed. So the feed of the banks collectively. Now, if euro dollar starts to rally in a news or event or a large amount of flows hit the market, what can happen is you on your interbank feed will see price move from, let's say, 130.17 to 130.25. So you'll see a spike in the market. Price will be moving fairly efficiently, then all of a sudden you'll see a spike, and we'll look at many examples of this. A small spike, be it 7 pips, 20 pips, 25 pips. The market moves because of an event, news, a Fed speak, or even a large amount of volume that comes into the market. And when this price moves, what happens is the engines within the bank, when price starts to move quickly, the engines will then take, if an entity comes in to their prime brokerage facility, executes a trade while price is starting to move fairly quickly, if they come in with, let's say, a $10 million order, then the order will spread out, and actually the bank feed will only be offering up liquidity on the opposite side of the market, will break down the order and flood the market, and the market has to spread and effectively chase price. That's in a market order scenario. Now, an entity may come in through the bank, and they may come in with $10 million at a market price. They may get partially filled at market price, but the price will still continue to run based on the event that happened, because it will drive interest in other market orders that are spreading to the high side. So what this does is it effectively creates a spreading in the liquidity volume over time. Okay, now while you may have orders at a set price that come in and get partially filled, you still have remaining orders or interest or psychological level down at the base. Now, while price has spread up to, let's say, 30.25 over a year at the interbank level, client A can come in at 30.17. Price can move to 30.25, but the bank can still deal it at 17 if they so choose. It all depends on their arrangement with the bank. So a large amount of liquidity can remain down at the base, depending on if it's done by phone or how they are set up electronically. So let's have a look at what this looks like on a chart, because we're all quite accustomed to looking at the chart. So if we bring a chart in here, this is a pound dollar 1 minute chart. And so what I've done here is I've just taken a price move that goes from roughly 60.70 or 60.72 up to 60.80, so it runs about 10 pips. Now, what we see here is we see a small amount of consolidation, and then we see something affect the market. Again, this effect can be a large amount, a large order that comes in, or there may be an entity that keeps bidding at 160.70 pound dollar. But as price starts to move, you can see how we have price moves. We have a move, and it just stops. It does not draw back, searching for liquidity to the bid side. It continues higher and continues higher yet again for a move of about 10 pips. Now, what happens is as the liquidity drives into the market and spreads higher, then what it does is it leaves a void on the bid side. Okay, because the bids that come into the market get spread up, and it effectively sweeps the offer book because prices thin out, sweeping the offers to the upside. Then price will drop back down. It will find its base of support as the orders settle down. The bids dry up and it leaves a void to the bid side. And this move lower is not sellers coming in. That's a different scenario. What this is the bids drying up, and then the bids find liquidity again when it comes back down to the base of the move. And this type of movement, if you see on a 1-minute chart, it happens virtually all day long. And this is reflective of the flows that are moving through the interbank market. Now, obviously, this level of volatility is going to change throughout the day based on opens and closes, market hours, events that come in and drive price, speak that comes in and drives price, and volume that comes in to drive price. Now, while price is pushing higher, and if I'm on the phone with the bank and price is at 60.80 on the aggregate feed, I can still get 60, 70, 72. If I've got, that kind of agreement. That's why when you're on the bank, and you see price move quickly, they can still give you a lower price because they're offsetting that order internally against somebody else who maybe has a different arrangement with the bank. They've got this room to play with. So if we move on and look at it under a different scenario, this is a little bit of a larger move because these moves come in all shapes and sizes, and it's important to understand that. Now, when I go through this concept, it's not really something that you're going to take home tonight and start to apply it in your trading. It's something that you need to grind out and really gain an intimate understanding of in order for you to integrate it and apply it into your existing trading regime. Now, if we look at this, another scenario here where price has moved from this is euro-dollar 1-minute chart, and price moves from, say, 37.70 to 37.90. I think this happened yesterday. We see this kick in right here on 37.70, and the longer the move, and we always consider sort of what the price driver was, or try to have an idea of what the price driver was. But as we see price move like this, and we see exposure to the downside, we anticipate that this eventually will start to dry up, and we'll look for a bit of a topping out process. But we see the engines come in, they're spreading the price. Price moves higher, and the magnitude of the event will determine the distinction of this level of order flow. Now, while price pushes up, it is seeking liquidity on the sell side. So if you have large orders that are being broken up and pushing for liquidity on the sell side, the higher it's going to go. And we'll look at another example in payroll in a moment. Now, price comes and settles down, and as you see price draw back in to the base, we see this virtually countless times every day. As price draws back into the base, filling up these inefficiencies, we see it once again react to the point of origin, or the point of the original bids, or the original place where price started to spread, and we typically see support. In this case, this move here, again, in these types of scenarios, this move is not sellers coming in here. It is a lack of bids. The bids have dried up. The market has created a void of bids as price draws back into the point of origin and creates some relative price stability. We see this type of behavior within ranges, within trends, and in all market environments. So we'll work with the questions. I was just getting so much on this audio issue that we'll have to deal with it. I don't want to look at the questions box. We'll deal with the questions towards the end there, if you don't mind. Volatility is a function of available liquidity. Price pushes to the less liquid side of the market. That's why And this concept is often why when the market, by a large majority, believes that the trend should be moving in a certain direction, the lack of liquidity is on the opposite side of the market, then all of a sudden you see price moving to the opposite side of the market, be it a short-term intraday trend or a long-term trend that applies even more profoundly. So let's just have a look at a payroll example and look at the function of liquidity and volatility. For example, you can see prior to this payrolls event, we saw liquidity was very, very, very thin, and you can just tell by the nature of the candlesticks here and the market behavior. Price gets so thin, and here we may have had a little bit of a jump in some volume, and then price sort of shifted. Then this is our pre-release, or our release price was right exactly at this point. And so what happens here in these payroll scenarios is quite clearly, as you can see here, the liquidity has dried right up prior to the event. So there's a massive void in orders where there would otherwise typically be liquidity. Well, it's lacking in this scenario. So when the news hits, it doesn't take very much liquidity at all to start to push price. So clearly there was an overweight in bids that came into the market following the news, and the bids, as light as they may be, simply have to find the offers. So price will jump in order to find the offers and fill up the next available price, and it leaves a massive void on the bid side and sweeps the book on the offers and the front end of the book on the offers. Now, and all you need is a few offers to come in to just draw right back down looking for bids. And typically, the market stability point is the point of around pre-release right here. So then we start to see liquidity, the market digests the information. You can see a big distinction in the nature of the candles post-event than what we saw pre-event. So now we can see a lot more liquidity coming into the market digesting the information. But this is just an exaggerated move of what we see every day, all day long in the market. And the volatility is a function of liquidity. So how do we use this basic concept in our trading? Well, we can still see price jumping around a little bit here, where price jumps, leaves a void of liquidity, comes back in and fills it. It jumps a bit here, comes back in and fills, moves out, comes back in and fills. And we've got a pattern that we look for is that the range of rebalancing after an event like this, once it breaks out to that side, typically that's the direction of the next move. Is something that we work with. But let's just have a look at this, a little bit closer still. We'll start to move. We got to start moving quickly through some of these slides here. Let's just have a look at it a little bit of a different way. And so if we take this price spike where we have price comes in, it's in fairly reasonable balance. This is a 5-minute chart. So we have reasonable balance in price here prior to an event or just simply prior to whatever occurred in this scenario. So once price started to move out, if it was event driven, you would see that the mechanism of order flow kick in. We cause a spike liquidity. Usually I'm looking at the candlesticks here to see the level of liquidity that prior to the event. It gives you a pretty good sense as to what kind of liquidity we're seeing. If we're seeing a little bit more liquidity, here's not too bad. If you see more liquidity, then the spike's probably going to be smaller. All right. Now, so here price drives out, and we can see a little bit of movement here. We reach a peak, and then the bids simply dry up. So effectively what happens here is the market orders feed into higher price levels than really psychologically anticipated in a lot of cases. And then the bids dry up, and we see a natural orderly decline, and typically the technicals are in good relationship with the leg up. But a nice orderly decline, and we come back down into the base where the bids originated, and we see reaction. So let's just to have a closer look at this, or to maybe just exemplify this further, we can just have a look at just what I've done here is I've just taken this price swing here, and I'm just going to split it in half and give you an idea as to how this happens. So the primary point that I want you to take from this example is that the price shift is in the exhaustion of buy flows. Okay, so the price retracement here is an exhaustion of buy flows. It's not necessarily sellers coming into the market. That's a different scenario. Okay, so if we just put some numbers out in terms of, buy side flows and sell side flows, if the buy side flows come in here and they're higher than the sell side flows, obviously price is going to go up. These buy side flows are constantly changing. And then of course, as the buy side flows start to dry up, once it runs up in price and the converters start to decline and their orders thin out, then on the sell side, the example that I'm drawing here is that on the sell side, we have constant flows. So it's not as though, in a lot of cases, we see the sell side dry up a bit after certain events. But in this case, I'm just saying the sell side does not change materially at all. What we want to take from this is that the buy side flows come in, the buy side flows dry up, and then as price declines, the sell side flows are still constant, which is obviously never going to be the case exactly, but I'm just doing this to make the point. If the sell side flows remain constant, the buy side flows simply dry up, and we see price decline back to its point of origin. Now, this is a type of move because there's a difference between buy side flows drying up and sell side flows coming in. And when you see a spike up like this, the consequence of the functional action through the interbank flows is simply breeds this type of behavior. And that's what we watch, that's what we look for. Now, obviously, if there's a very, very profound piece of news that comes out, typically it's related to anything connected to monetary policy, then you might just see this thing continue and just stop. And that's fairly normal because there is a distinct and material element that comes into the market that causes this fundamental shift, which reaches right down into the bond market, which really solidifies the story. But let's just continue to move through here. What I'm going to do is I'm going to start with lower time frame charts and then move to the higher time frame, just to draw out some examples and how it shifts based on time frame as well. Okay. Okay. So this is just a 1 minute chart, and I'm not suggesting that you consume your time in staring at 1 minute charts and become a scalper. I'm just saying it's important to understand some of this market behavior in relative terms. So we'll look at different time frames. So when we see this type of behavior, price run, we typically see it feed back into the area of volume support or liquidity support here. Price runs up, and we see it back here. Price runs up, and we see it pull back. This is very, very normal behavior. Anytime we see this, if you look at this in terms of volume and transactions, it creates a psychological connection with the market. When price moves out, it typically will draw back in. And in this case, price rallies and stalls. So on smaller levels, price rallies. There's the mechanism, draws back, finds its support here. Even on this down move, there's an exposed area right here, and it rebalances back into this area where the bid becomes the offer. And we slowly drift back, and these price relationships exist across the board throughout the entire day. And you can see the responsiveness to this level, and even on these smaller moves, there are distinct price relationships. So if we look at another 1 minute chart, you'll see that there is here at 61.45 to 61.60. So it's a 15 pip move that we have where price runs, and it's effectively runs nonstop. And then, how do we know where it's going to stop? That's a whole other story. No one ever knows for sure where it's going to stop, but we have areas where we view that there's a level of probability to where we'll see this flow stop. But you can see the distinction between when price stalled here and it ran up another leg and drew right back into this area of support, back up to the highs, and then even immediately, you see how distinctively exposed this leg is? You can virtually only have a few ticks, just creating that exposed area. Price comes back and to the support, and then it slowly works its way back down to the foundation of the move. And in the meantime, this price behavior is continuing on its entire move all the way back as well. Past that one. So here's a 5-minute chart, and let's just have a look at, again, at the mechanism where we have a release point where there's a spike in the buy flows, and obviously the buy flows need to find that liquidity, so the engines will spread the orders out. The spread will typically widen, and the market just simply has to find liquidity to the sell side. Once it finds sufficient liquidity, it starts to slow up, and depending on the magnitude of the event, will typically determine the exposure of the bid side and whether or not the bid side will dry up. Now, most often on a relatively inconsequential data release, we will see these exposed areas quickly come back and rebalance before the next move is taken on. And you can see here that liquidity is fairly light. You can tell by sort of the block-like candles here. And when price tightens up, we have very, very little volatility as it bleeds back. And even, this block-like candle spikes back up, feeding into this level right here. Liquidity is quite light, and then it starts to pick up a little bit as it comes back into the base of that spike. The market digests the news, and then it waits on the next piece of news, which occurs at 12:30 GMT. So the market spreads, creates voids and inefficiencies, comes back, rebalances, and then waits on the next piece of news. A spike in volume, price pushes out once again, leaves an exposed, inefficient area, and the pattern is almost virtually the same. So you see how price spikes, and then it rebalances near in the top third. Price spikes, and it consolidates in the top third, and then you see how price breaks that level, and here price breaks the level, and then it consolidates, and it comes back down to the initial breaking point and point of origin of the move here. So these repeated patterns, and you literally see them every day in the market, and they come in different shapes and sizes, which you need to have the ability to adapt to just by studying it over time. But a very, very distinct price behavior. So on this 5-minute chart, what we see here is we see these price relationships where you can have, for example, here we have a spike lower, leaving an exposed, that's what I call an inside price surge. We have an exposed area on the inside. It has effectively rebalanced this up leg. And when price draws back up, filling in this exposed area, it's actually creating a whole new price relationship and leg of its own. So it moves back in, creates another inside surge, and so it has just struggles getting through that 50 level, and then it draws back in, filling in that exposed area where price rebalances and moves forward, waiting on the next driver, or the flows become more efficient or more stable as the trend either moves up or down or sideways. But in each of these cases, we see how the dealing mechanism has totally exposed the movement. Here we see multiple patterns within one pattern. We see an initial sort of price surge here, a distinct breaking point. So we see a price surge, Price holds, takes on another surge. This leg right here is a spike of its own, even though it's, say, 20 pips. We like the smaller spikes. Price comes back, and in the meantime, it's actually creating a whole price swing. But let's just stay focused on this. Price surges. We have an area of deal flow, and typically these can be isolated. So we have an area of deal flow here. Price drops. We had an area of deal flow here, and price drops back into this area of consolidation here, offers support to the market. It drifts off, and the next news event kicks in, and we see the same pattern. Notice how here price, it rallied and stalled, broke above, came back, found support. We see the same pattern. Price breaks above, comes back, and it stalls right on this area of support here. And then we move into the next day of trading. And then during Asia, this entire swing feeds back into this breaking point. Okay, so what we're seeing here is we see one deal run, price spike, feeds back. Another one feeds back. They're all within the context of one larger price swing, which has a pattern that is repeated inside the pattern. And even when you look here, we can see the same pattern, spike, consolidation, feeding back into the breaking point. But what's important to keep, as much as we can quite simply identify these price behaviors, we need to keep focused on the mechanism, the dealing mechanism. How are we doing on time here? We have to wrap it up in a couple of minutes. So here we see a price spike, topping out, comes back, responds to the point of origin. This type of behavior is confirmation of the dealing mechanism and the point of origin and the order support that we see down at the release point. I wanted to take us to, I want to talk about this. This is on a higher time frame. So here's the 60-minute chart, where we see this pattern play out multiple times just on this one chart. We see it almost every single day in the recent market environment. We see it repeatedly. We have stable volume, where psychology is fairly passive. When the event, whatever the event is, it hits, the volumes will increase. It will spread, sweeps the top end of the book. It might get a little bit deeper, but when you see this occur on a larger time frame, when price rallies and holds, usually the event is an event that is more profound in terms of its relationship with monetary policy. And you'll see price rally and stick. And then some time will go by, and then the market will view the next event as overriding its level of importance of this event or not, and then price can just simply give it back the next day. But we see this pattern repeated on the higher time frame. It effectively leaves a void of bid, and when it leaves a void at its base, then typically there is still a very, very profound psychological connection with these levels. And while certain orders, if they have not gotten filled, depending on the objective of the party involved, they can still provide liquidity to the market when price gets back down to that level. Okay, so the way I've got a quick question here. I can maybe get into some questions. We had a number of other slides. We can maybe do a part two. But a question is, how are you trading this price action? Are you trading when it returns to rebalance? Anything on these small intraday time frames that can alert us to multi-day move? Now, this presentation, I think, it's more about understanding the concept than the process that one would want to take. As if you want to get a deeper understanding of this concept, what you do is you take you take the features and what was discussed here and you test it out. You probably do sample size of, let's say, 500 samples, and then decide whether or not it is something that you can connect with, and then determine how it fits into your trading model. The way that I trade intraday is I trade price volatility. So I'm looking at that slide here. I'm simply trading the intraday volatility. So if price is here, I've got levels where I'm looking for price responsiveness. So that's one way that I'm trading. So I'm looking for pre-established levels that I have, or I'm looking at price behaviors that are setting up at any given time. That's how I'm trading the intraday model. I have different models that I trade, but for intraday price action trading, that's effectively what I'm looking for. There are a good number of other price features. There's a lot to be considered: time of day, what's driving price, what's the macro sort of fundamental scenario, what's the flavor of the week, things like that. So that's basically how I'm trading. But it's rather than just jumping to how I trade and when do I get in, we need to break down the price characteristics and features and understand them, and then start to pull them together. I like to have my levels off the 30 or 60 minute chart typically, but I'm obviously looking at levels also on the daily charts. But when it comes to execution, I'm looking at the 5 minute and the 1 minute charts. But the levels of distinction are coming off of the higher time frames. Okay. So a question here: difference between exhaustion and real sellers. Yeah, that's a little bit different. That's a whole other lecture. But it's important just to understand this concept first and build from there. But even just with this concept alone, I think what you want to do is, because many people who are in this room, people trade quite differently. You've got some people who maybe are algo traders, and others use mathematical models and indicators. I don't use any indicators. I think price action brings us closest to the psychology of the market. So I like to trade price action. So these are price action features, and I believe that price action features can certainly be integrated and brought into consideration if you're trading mathematical models, for example. So it really just needs to be adapted to how you trade, or if you're just sort of in the early stages of developing as a trader, then it's important to build a proper foundation. My suggestion is, if you're in early stage development as a trader, don't just take somebody else's model and stick it on your charts and follow a 1, 2, 3 step, trading approach, because it's just not going to work. You need to understand the market in depth, and that's why I like to share this kind of information, so that it gives you just a bit of a foundation to start to build from. Jonas, yeah. So in essence, supply is constantly in the market, but the environment changes when buyers enter. Is based off of certain factors. Yes, and liquidity and the state of the market at the time, because the market is constantly changing its state. So, for example, you may see volatility pick up, and then you see volatility dry up ahead of certain data points, where price will draw back into the day's range prior to the data event. So the tempo and the liquidity and the flow of the market is constantly changing based on the macro scenario. There may be a very, very profound macro scenario that's running the market at the time. Usually it's connected to monetary policy. While when the market is in a stable environment and somewhat range-bound, we really like the range-bound market. When it's stable, we see the data points come in and drive volatility, and we really like that because in a macro stable environment, interim data points giving shots into the market give us some good liquidity spikes to work with. Stop runs are a bit of a different story. It's what we call a liquidity void, and stop runs are, it's a bit of a different subject matter, but I'm not I'm not a real person who's I'm not the type of person who, because I've had a lot of conversations with the banks about this, and there's just not a lot of substance behind the stop run scenario. However, we look at, if we pull up a chart, I don't know if you can see this chart or not. By the way, this is a euro chart from today, and these are just what we talked about today. We actually saw it happen 4 times in the last. But let's just have a look at. So stop runs, for example, if we go to a euro dollar daily chart, typically what you see is when the euro dollar was moving towards, let's see, pound dollar. When the pound dollar was running towards the highs right here, what happens is we saw a spike through the highs, then price drew back into the range. Okay, usually you see that there's like a liquidity void, and you might have a few stops up there that run price up, and then when that dries up, it's the same concept that what we just talked about. When that dries up, then price draws back into the range, and usually it creates a bit of a weaker collapse on that leg into the highs. So while there might be buy stops, but there are also maybe buys looking to buy the break of the highs. Sorry, some of the questions are getting buried here. I'm not sure how much time I've got here. Where's our host? It's my first event, so I apologize if I'm not moving too smoothly here, because it's a new platform for me, a webinar platform. What type of macroeconomic events do you see as having impact on your trading? I pay attention to monetary policy. Anything profoundly affecting monetary policy, because the interest rates typically dictate the macro flow of the market. So the tighter the connection with direction of monetary policy, typically the greater the trend driver for short or long term. And then you have your flavor of the week too. You know, for example, jobs is important because the Fed has anchored a number with the unemployment rate to their decision on tapering. So jobs, the market's going to focus on jobs as it always has, but it's going to be a flavor. Yes, I trade historic support and resistance levels. Yes, deep into history, deep into history. How do you explain when there's a huge run-up on the buy side flows followed by only a horizontal sideways movement, then price continues up? Yeah, okay, that is typically, if you see a run-up in price, like let's say, this is a daily chart, but like this, for example, and the sideways movement, this is usually quite closely connected to or directly related to monetary policy. So you see a price move, sideways movements. Usually this is and I believe this was a non-taper scenario right here, and that's what happens. As well, you combine that in this case with what's going on in the UK, where withdrawal from liquidity is also they're moving closer to withdrawal of quantitative easing. I trade order flow also without indicators, and I'm looking for price moving from liquidity pools to liquidity pools based on swings. Yeah, as long as you have gone through the process of validating the nature of the price behavior or your mathematical models, as long as you've engaged in a process that concretely solidifies really and validates your approach, then I think that's the main thing. And then of course, building a risk model around these features where you can clearly assess probabilities. Yeah. So, like, for example, if you said that I trade this way and it's something that I have not personally validated, I'm not going to tell you that it's wrong, because if you've validated something that I have not invested the time in validating, or have overlooked it, or it doesn't play a part in my trading, doesn't mean there's anything wrong with the way you do something. And that is something that I think people need to, really early stage developing traders need to get their head around, in that you can do something that has been created by your own independent thought, when in fact the most profound elements of your trading are going to be validated just by your own instinct and by your own experience. When watching a level, do you enter, or do you have an order already in? Typically it's a market order, but I do, for swing and position trades, like right now in dollar Canada, I'm trading it to the long side, looking for a very, very long and painful move higher. I will leave limit orders in the market for position type trades. For intraday trades, market orders usually. There's what do we got here? I've got a website here. If you go to chrislaurie.com, there's you can join for free, and there's educational videos and ebook in there. I post institutional research as a blog and whatnot. So you can go there and check out some other videos similar to this one. Do you also consider important a level if it is recent price action? Let's say goes through it 2 times recently without giving it importance, then also don't consider it important. I'm not totally clear on the question, but I'm not totally clear on that question, Gabriel. I'm sorry. Let's say price moves through a big figure, like inefficiently a couple of times, but comes back to the big figure. I would probably still place some importance on it, but to me, the price behavior overrides all secondary features like Fibonacci's and numbers and other technical features. The price behavior overrides. Okay, admin, thank you, thank you. I apologize, folks, if I was a little bit sticky today, but it's my first time with this platform, and I apologize. Even though the test went flawlessly, of course. We can get into this kind of stuff into more detail in future events. Thank you to FX Street for this opportunity. And the webinar will be recorded, folks, and you can find it in the archives.